Good afternoon. Today we're going to begin the last chapter of the quarter, completing the audit. I guess that's kind of appropriate today. 4 periods of time, the interim period, A, B, C, and D. So interim is a vocabulary word. We try and do as much work as we can during the interim period. If you think about an accounting firm, most firms have a year end of 12/31, not all firms, but most firms. And so you can't complete the audit until after they finish the year. So you have a lot of work crammed into January, February, March. It's seasonal, and the firms are looking for ways to spread out the work throughout the year to make it less uneven. So they try and do work before the year end, before December 31st. Internal control work, do a lot of internal control work throughout the year, and it's for 2 reasons. Number 1, it needs to be done. Number 2, it's an attempt to smooth out the work a little bit. So interim is work you do prior to the date on the balance sheet. So 4 periods, interim B, that's where we're going to start. We're going to start after December 31st, the date on the balance sheet. We can't actually start the audit until they've completed their financial statements. So that's where we're going to start our audit. Here's Tad's outline of the chapter. We're going to start out in the blue area, contingent liabilities, subsequent events, management representation letter, and analytical procedures. So that's where we're going to start. Unrecorded liabilities. Now we started unrecorded liabilities when we audited cash. If you remember the bank confirmation, the second section of the bank confirmation had a list of loans, and we're asking the bank to confirm those loans. Are these correct? So if they have any loans that they conveniently forgot to tell us about or forgot to include on their financial statements, we're asking the bank to help us find those unrecorded liabilities. We've been talking about auditing cash disbursements after January 1st. Well, we're going to look at a lot of the purchases of payments in January, because we want to make sure that those payments were for things actually purchased in and recorded in the correct period. So they make a payment in January, it may well be for something they purchased in December. So we're going to look real close at the cash disbursements in January, especially early January. In the example in the book, they found $5 million worth of purchases where the payment was made in January, but there was a liability as of December 31st that had not been recorded. Search for unrecorded liabilities. Contingent liabilities, contingent loss. Some people call them contingent liabilities, some people call them contingent loss. If you look at the entry, it doesn't make any difference. The debit's called a loss, the credit's called a liability. Potential future payments from an existing condition. We're uncertain about the amount, and the outcome will be resolved by some future event. Lawsuits are a great example of contingent liabilities. Income tax disputes. If you think about your company, if the accountant tells you, well, I'm not sure whether this is a deduction or not, I believe, as I understand the law and the regulations, I believe we're allowed to deduct it, but I'm not sure. Are you going to deduct those kind of things? And I think most companies will if they believe that it probably is allowed. So their income tax disputes can be a contingent liability. Guaranteeing the debt of others. That's something Enron did a lot of, was guaranteeing the debt of special purpose entities. We record contingencies when they're probable and the amount can be estimated. Then we're going to make a journal entry and record the loss. If it's probable, but we can't estimate the amount, we're going to disclose it. You can't record a journal entry unless you can estimate the amount. If it's reasonably possible, then we're going to disclose it in a footnote. If it's remote, we're just going to ignore it. Now, these are three important words here because for the most part, accountants deal with uncertainty as probable, reasonably possible, and remote. Probable is what we think is actually going to happen. Remote, it could happen, but it's not going to. Reasonably possible is more likely than remote, but less likely than probable. So these are 3 degrees of uncertainty with which accountants, words accountants use for uncertainty. Probable should make sense. The definition of an asset, probable future economic benefit. Liability, probable sacrifice, probable future sacrifice of an economic resource. So as accountants, we don't record things unless they're probable. That's the degree of certainty we require. So probable, reasonably possible, and remote are 3 kind of important words. A few accounting standards related to income tax expense now use more likely than not. But for the most part, we deal with probable. Here's the same graphic, just visualize different. If this helps you visualize it, go for it. If it's probable an estimate, we accrue the loss, make a journal entry. If it can't be estimated and it's probable, we disclose. If it's possible, reasonably possible, we disclose. Remote, we don't do anything. What are our audit procedures regarding contingencies? Inquire of management. We're very dependent on management. Review the minutes of board meetings. Analyze legal expenses. So we're going to look through all the legal expenses, all the payments they made to attorneys during the year. Now, not all payments to attorneys indicate a lawsuit. So what we're worried about are payments to defense attorneys. They're going to have payments to all kinds of attorneys. If it's a big company, they're going to have payments to people help them structure deals, people ruling on whether a transaction is legal or not, people helping with the legal aspects of taxes. But what we're worried about is where they hire a defense attorney. Somebody in your office can look down the list of attorneys they're dealing with, and they'll know which of those attorneys are defense attorneys. And then we're going to obtain a letter from each major attorney, a letter of audit inquiry or an attorney's letter, don't care what you call it. We're going to get representation from the lawyer. Management is our primary source regarding information about litigation. Inquiry of the client's attorney is our most important source of evidence to support management's representations. So management gives us information, but we need evidence that information is correct. So the client is going to prepare a list of pending litigation and any claims against the company. Then we're going to ask the lawyer, so the client prepares this on the client's letterhead, then the lawyer will tell us the likelihood of an unfavorable outcome and the amount of potential loss or the range of losses, and a statement that the list is complete. So the client prepares it. The client prepares the inquiry, a client's attorney, the attorney's letter, prepared on the client's letterhead, They mail it to the attorney mails it to the auditor. There's going to be a lot, of course, of discussion between the client and the attorney if this is a significant lawsuit. The client's not just going to send this to the attorney without talking to them. They're going to ask the attorney exactly how to structure it, how to word it. The attorney doesn't want to walk into court with a document that shows that the client's guilty. So there's a lot of hem-hawing around with the inquiry of client's attorney letter. The AICPA, pardon me, the FASB, I'm sorry. The FASB tried to rewrite the accounting standard related to the attorney's letter, and they tried, and they got so much pushback from the clients, the companies that prepare financial statements, and from attorneys. I think they finally gave up on it. So this is a really, really tough situation. If the client's attorney doesn't respond to us, we have a scope limitation, which means we would either issue a qualified opinion or disclaimer of opinion if it's material. Qualified opinion, first paragraph's unchanged in our opinion, except for the possible effects of the matter discussed in the basis for opinion paragraph. Everything else fairly presents. We're going to add a paragraph in the basis for opinion paragraph to explain the issue. Then we'll have our standard basis for opinion paragraph. We conduct our audit in accordance with generally accepted auditing standards. No need for an emphasis of matter paragraph. Responsibility of management section never changes. In this case, there's no need to change the auditor's responsibility section. If it's hugely material and significant, we might issue a disclaimer of opinion. There, when the first paragraph would be changed to say we were engaged to audit. Second paragraph, we do not express an opinion because of the significance of the matter discussed in the basis for opinion paragraph. In the basis for opinion paragraph, we're going to add a paragraph or whatever is needed to explain the issue. We didn't conduct an audit in accordance with generally accepted auditing standards, so we'll scratch that out. There's no need for emphasis of matter paragraph. Responsibilities of management never changes. The auditor's responsibilities section will be totally rewritten. Subsequent events. New topic, subsequent events, and this is something students struggle with. Subsequent to the date on the balance sheet. That means the event occurred after 12/31. Make sure you get that through your head. It becomes very clear when I grade the final that students don't think about what subsequent means. If it doesn't happen after 12/31, it is not a subsequent event. Okay, we're still in the blue period. There are two types of subsequent events, and the question we're dealing with here is how do we know whether to make an adjusting entry, include it into the financial statements, or disclose it in the footnotes. So page 788, the book says those that have a direct effect on the financial statements and those that do not have a direct effect. That's not good enough. Usually if the book says it, then even if I disagree a little bit, I buy it and will go along with it. This isn't good enough. Now it does say auditors must distinguish between underlying conditions that existed at the balance sheet date and those that arose after the end of the year. That's the key thing there, the underlying conditions. So here's what I want when I ask for this on the final, for subsequent events, what I want, type 1, that require an adjusting entry, which require us to adjust the balances in the financial statements, are those subsequent events that provide evidence about a condition that existed as of the date of the financial statements. So the event was subsequent to the date on the balance sheet, but the underlying condition underlying the event existed as of the date on the financial statements. In that case, we're going to book an adjusting entry and change the numbers on the financial statements. Type 2, we disclose subsequent events that provide evidence about conditions that did not exist as of the date on the balance sheet, but arose after the date on the balance sheet. Spend some time with that. I can tell from many years finals, students struggle with that. Why will I ask it again? I'm going to keep asking it till most everybody gets it right. I would have stopped asking it by now if people got it right. Here are some examples of type 1 adjusting journal entries. Declaration of bankruptcy by a customer with a large account receivable. When I think of accounts receivable, I tend to think of Walmart with millions of customers. But not all businesses have that many customers. We audited a copper mine that only had 9 customers. They sold copper to 9 customers. So any one of those customers probably would have had a material impact on their financial statement. So if a customer goes bankrupt in January, if we would have known that, would we have had a bigger allowance for doubtful accounts? Settlement of litigation for an amount greater than recorded. Sale of an investment for less than the recorded amount. So let's look at our little make-believe financial statements here. We've got accounts receivable. We only have 9 customers. Each one of our customers has a balance of $10. So in January, one of their customers goes bankrupt. Gosh, would I have a bigger allowance for doubtful accounts had I known that customer was in financial distress? Yeah, I think so. Okay, then book the entry. Bad debt expense allowance. They've got an investment in a subsidiary on their books. Now, this is not a publicly held company. We don't really know what this subsidiary is worth. It's just a guess. The stock in the subsidiary doesn't sell on the open market. They've got it on the books at $200 as of December 31st. In January, they sell their subsidiary for $175. Oh, well, unless something really drastic happened in January, that's probably a better indicator of what the subsidiary was worth at December 31st. So go ahead and book the loss. They've got a contingent liability on the books for $50. It's a lawsuit. And then sometime in early January, they sell the lawsuit for $55. Oh, okay. Go ahead and adjust the balance and the liability on the financial statements. Okay, so those are examples of type 1 where we go ahead and book the entry and adjust the financial statements. Type 2 disclosures are subsequent events. The event occurred after January 1st, and the underlying conditions arose after. So if a company issues bonds or stock in January or February, or is planning on issuing bonds or stock, they'll have a footnote explaining it. If the company enters into a merger or acquisition or is in the process of entering into, they should disclose it. If they had a major loss due to a fire or natural disaster that occurred after January 1st, they should disclose it. Auditing procedures for subsequent events, inquire of management, read internal financial statements. You should be aware that companies don't wait till quarterly and annual financial statements to manage their company. Some way, shape, or form, they have internal reports throughout the year with which they try to run the company. The car dealerships that I worked for had little mini 10-day financial statements. They weren't comprehensive, they weren't particularly accurate, but they showed us which way the arrow was pointing. So find the reports that the company uses to run their business on a day-to-day basis and review those. Read the minutes from the board of directors meeting and obtain a management representation letter. Okay. This is a required procedure. So auditing standards require auditors' responsibility to obtain written representations from management. Okay. This is a required auditing procedure. I want you to just read it once. The example in the book, just read what they say once. Don't memorize it. I'm not going to ask you what's on it. Here are some examples of what's on it. A statement that management's responsible for the financial statements. A statement that management believes the financial statements conform to GAAP. That all financial records have been made available to the auditor. That all minutes of board meetings have been made available to the auditors. All information concerning fraud or illegal acts of which the client knows has been shared with the auditor. All information concerning related parties and related party transactions has been disclosed to the auditor. Lawsuits and unasserted claims that are probable have been disclosed to the auditor. And any subsequent events about which the client knows, they've told the auditor. So this is just that you don't have to memorize it, but this is the type of thing that goes into the letter of representation or the management rep letter. So you'll hear people call it the letter of representation. You'll hear people call it the management rep letter. It's the same thing. The senior management of the company prepare the management rep letter on the client's letterhead. The CEO and CFO sign the management rep letter. It's addressed to the auditor. So it's prepared by the client and sent to the auditor. If the client refuses to prepare a management rep letter, we have a scope limitation, qualified opinion or disclaimer opinion. We just went through that, so I'm not going through it again, but it's right there for you if you need it. Oh, would that be fair game on the final? You betcha. Waived or past adjustments. What this is we come across an error, but it's so insignificant, it's a who cares. We're not going to have the client adjust all those little errors. So we're going to come across something that's totally insignificant, I mean, nowhere near material, and we're going to waive the adjustment or pass on the adjustment. We're not going to require the client to book all these little adjustments that may come up. But we are going to keep track of them. We're going to keep track of them, whether they understate net income, overstate net income, their effect on current liabilities, current assets. And we're just going to keep track of them for a couple reasons. Number one, is it possible that as more and more of them occur, that they approach materiality in aggregate? Don't want that to happen. And the other issue is we want to see if hopefully some of them would increase net income, some would decrease net income. So I look over at the far right and I've got some increase, decrease, decrease, increase, decrease. So yeah, there appears to be a fair game. I know management's biased, but I don't want it to be totally biased in one direction. Down at the bottom in the lower lower left-hand corner, you can see that the effect on current assets is nowhere near material. The effect on total assets is nowhere near material. The effect on income before taxes is nowhere near material. So I'm happy. Where did those materiality levels come from? If we go back to page 247, the book is really consistent with bringing this example from Hillsburg Hardware all the way through the course. So these levels of materiality were determined early in the quarter back on page 247. Analytical procedures, we'll perform them at the planning phase, the substantive phase, and at the conclusion of the audit. Auditing standards require us to perform analytical procedures in the planning phase, and they require auditing standards require us to perform analytical procedures as an overall review at conclusion of the audit. We can use them as substantive tests, but that's not required. Ted's always going to recommend you do them as substantive tests because they're cheap. Okay, so here's the auditing standard, and it shows that, we got to do it in the planning phases. We have to do it at the end of the audit. We can perform analytical procedures as substantive tests. Now, we finished field work. Okay, so they send us home. The manager, senior manager, and partner all huddle to figure out what report to issue, but we're done. As staff auditors, we're going off to another client while they wrap up the odds and ends of the audit. Okay, that's everything for today, and we'll finish up chapter 24